we have a lot more time to catch up between tomorrow and day after as well. So I don't intend to rush into any topic. We'll go at this pace. If you think it's slow, please let me know. I'll quicken the pace. If it's going fine, we'll keep this pace. And I have absolutely no problems in extending by a few minutes today, a few minutes tomorrow, day after. So please feel absolutely free. We'll run it the way you guys want. Okay, SPPI criterion, as we said, is something which has elements of solely payments of principal and interest. Now, what is principal? Principal is the fair value of the asset on day one, which means if on day one I have given 100 rupees and the entire instrument had market related terms or had the same terms which would have been available generally in a market, 100 rupees becomes the principal on day one. That principal, of course, keeps changing as repayments happen, right? So repayments will reduce principal, but by definition on day one, principal is the PV or the fair value of the instrument on day one. Interest is compensation for time value of money, credit risk, liquidity risk, certain administrative cost and a profit margin, right? Because remember, at the end of the day, we are all there, all lenders are also there to do a business. The standard recognizes that, and basically it says principal is fair value of the asset at day one, which could change over time as repayments or prepayments happen. But basically the interest is time value of money. It has a compensation of the credit risk associated with the principal outstanding. There is also a consideration for other basic lending risks like a liquidity risk and administrative cost with a reasonable profit margin. Very intuitive to understand. All entities are there to do business. Think about it. It's not different from any manufacturing entity. You have cost of material, labor, overheads. You have a profit margin. If you are in the business of lending, you have cost of funds. You have an administrative cost because there is an OPEX which is sitting in the entity. You have liquidity cost. Basically, liquidity cost is that if I have a 5-year loan, I would have borrowed money for 5 years and then lent it on 5 years in an ideal world. Now, if after 2 years somebody comes and prepays the loan, I am left with cash, which I may not be able to deploy for the next 3 years, and I continue paying interest for a 5-year rate, right? So there is a liquidity risk that an entity runs. It's absolutely fair to add some bit of premium for a liquidity risk. And finally, profit margin, because I have to make money at the end of the day as an entity. This is a smell test, right? If it smells like principal and interest only, it is principal and interest. The moment you start introducing funny concepts in this, try and tweaking the concepts, it fails SPPI. It should, whatever is the ordinary understanding or the common sense understanding of interest is what the standard is also looking to bring out in the guidance. Now, let's take some examples of features in a contract to see whether they meet each of these risks. Remember these icons, I'll maybe flash them again. The rupee symbol is for time value of money. This is a credit card, which is credit risk. This is liquidity and profit margin. Now, I'll mention the term and tell you where it fits. We'll obviously have a few case examples to clarify the concept. Let's suppose today I have taken a loan which is at LIBOR plus 2%. Right? Now, do you think this would meet the liquidity risk, credit risk, time value of money and profit margin? Or because it's a variable rate of interest, SPPI is not met? So key question, would variable interest rate meet SPPI? That's right. So just because it is variable, just because I don't know 2 years later in rupee terms how much interest I will pay, does not make it fail the SPPI test. I am able to determine what the interest will be, and it's only time value of money. So it meets all of them. Typically, you will have all of these elements baked into a variable interest rate. What about a prepayment feature? So the feature I'm trying to talk about here, and once again I'll make it clearer on this, is 5-year loan, but prepayable after 2 years or after 3 years at 2% fee. Right? This is a prepayment feature, very common that we see in a lot of loans. Forget the chargeability or whether it can be charged or not. Let's assume it's there in the contract. Okay, we are saying, we are getting responses saying yes, it meets SPPI. Okay, that's right. So basically, it meets SPPI because there is an element of time value of money. There is a compensation for liquidity risks. The only point as an auditor that I would additionally look at over here, and that's where the devil is in the detail, is it is 2% of what, right? If somebody tells me it is 2% of original disbursement, then I would be skeptical. Because let's take the example of a 100 rupee loan. I have paid 3 years, right? So let's assume 60 rupees of the interest is paid out, or of the principal is repaid. Now, when I'm prepaying 40 rupees, basically I'm asked to charge, or I'm charged 2% on 100, which was the original loan amount. Now, this could call into question whether it's time value of money or not. So, in most cases in the Ind AS scenario, when we have seen, well, it is comparable to market, but the question is, we have to look at the contractual features to conclude. Maybe 2% is not a big amount, but for example, if you could have a structured transaction, that 2% could go to 5%, could go to 10%. Point is, look at the clauses in the agreement. If you are going to pay something which is not smelling normal, right? Because I would, as a borrower, I would be a little bit taken back if somebody told me, I gave you a loan of 100, now you pay me 2% of 100 5 years later or 3 years later as prepayment penalty. But it's a point worth thinking. It's a point worth asking our clients and evaluating whether SPPI is met or not. Out of my practice, I can tell you in most cases that we have seen, this does not impact SPPI because 2 reasons. One, it's normally of the outstanding amount, and it's a reasonable compensation for early termination. I have not seen people charging an obscene rate of 5, 10 or any such percent which would impact the assessment. The idea here is to try and make everyone aware of what we could end up seeing. The third example is of a variable compensation for credit risk. Now, basically here I'm telling that when the loan is disbursed, the credit rating is AAA and the interest is say 8%. Later, the agreement says if rating drops to say AA, interest is 8.25%. Do you think SPPI would be met here? Absolutely. It is purely compensation for credit risk. Similar to the first case, credit risk has increased and charging more. Feels like interest, looks like interest, it is interest. Yeah, we spoke about prepayments. Basically, if you are going to charge a prepayment at fair value and say prepay whatever is the outstanding principal and loss of interest, it is time value of money, it meets SPPI. Okay, this is one example where we should maybe spend little more time and talk about it in a bit more detail. which is embedded derivative in a hybrid contract, right? So I have a bond or a convertible debenture, and the terms of the debenture. So basically I have a convertible debenture. Now, how would you identify if there is an embedded derivative in this? The key trick is you look at the interest rate in the market versus the coupon. This is a very good way to identify some of these items where SPPI fails. In a lot of these instruments, you will see differences between the market interest rate for a simple debt versus market interest rate or the coupon that is charged on this instrument. The moment you see a convertible debt, it's typically a derivative linked on the value of the underlying equity shares, which is getting baked into the assessment. That fails all kinds of tests. I mean, sure, there may be some element of time value of money through coupon, but it is not only principal plus interest. And that's where the word solely becomes important. It has to be only principal and interest. Yes, this S is very critical, sole payment of principal and interest. The moment you see something different, it fails SPPI. Well, the last one again is a bit tricky. Basically, this is an example where your interest payment happens every month, but the reset is 3 months, right? So you pay interest first of every month, but the interest rate reset is 3-month LIBOR or 3-month MIBOR, 3-month MCLR. That does not automatically meet the time value of money criteria. There is a basis risk inbuilt. So if interest paid is monthly, but the rate used is a 3-month rate, please be careful, there is a basis risk. Now, you will have to do one additional analysis to say in present value terms, is this modification a significant difference or not? Generally, in the examples we have seen, it is not, in which case your overall SPPI is met. But this is something to be conscious about. Again, some of these may not be commonplace, but please be conscious about some of these. Okay. So let's now once again move to some examples or case studies.